Good afternoon, and thank you for joining us for today's webinar, GASB Statement Number 101, Compensated Absences. I'm Becky Wyan, and I'm part of the marketing team here at Ray, and I will be moderating today's presentation. Before we get started, though, I'd like to cover just a few housekeeping items. If you have any questions during today's presentation, you may enter them in the chat box on your screen. We will try to answer as many questions as possible at the conclusion of today's presentation. However, to be respectful of your time, we know that we may not get to them all. So after today's webinar, we will review all questions and send them out via email if needed. We will also send everyone a copy of the recording and the slides that we will be seeing today. All right, to get started, today's webinar is given by Jared, a principal on our Ray's government team, and he will prepare you and your team for one of the most significant financial reporting updates of the year, GASB Statement Number 101. Welcome, Jared.
Yeah, thanks, Becky. Appreciate that, and thank all of you for joining us today. We've done these webinars before. You may have joined us for our webinar that we did on GASB 87 and leases, or maybe GASB 96 for Savitas. But there's good reason that we have these. One, we get good turnout for them, so there appears to be interest. But we also found them to be very helpful in our collective implementation of these new accounting standards. The GASB has kind of not been so nice to us lately with pushing out all of this new material, very technical, very challenging. So we found the best way is to get in front of it. We got a couple early implementations under our belt with the school season we just had back in the fall, and communicating with our clients, and communication. This is just the start for that communication. It's just a really high level. Hey, here's GASB 101. Here's what we need to do. But by no means is this the end. In fact, there's a very good chance that within the next week or two, you'll be hearing from your specific financial statement preparer about, hey, what questions do you have? You know, do we want to have a meeting? Do you want us to come out and go through some of these materials with you? But we do find it key to kind of hit this early with all new standards. I mean, the last thing we want to do is be dealing with this, depending on what your filing deadline is, late May, still dealing with GASB 101 to get your financial statements out the door, possibly holding up your Hinkle submission or your act for filing. So thank you very much for being part of this today. And I guess without further ado, I'll get started here. So GASB 101, again, GASB 16 was the last standard that addressed compensated absences. So it's been a while. So we've got, all fiscal years beginning after December 15th, 2023. That's the requirement. So we, our calendar year clients, our 12/31 clients this year are the first to implement GASB 101. Our school districts, all of our June 30 clients don't have to implement this. So I know we have some school district representation on the webinar here today too. You won't have to implement this until fiscal year 25. But like I said, we did a couple of our schools last year just to kind of get our feet wet and start to get comfortable with the requirements. And very glad that we did that. It's definitely a learning curve, and feel much in much better position now to implement this with our cities and counties and libraries and villages. And I think, as a matter of fact, I think it's going to be a bit more challenging. I think our schools, and I'll talk a little bit more about this, and it was the reason we did those early, is just a bit easier. Cities and counties are a little more decentralized, so I think it's going to be more of a challenge, and we'll talk about some of those challenges. With this implementation, you are once again going to have to do a restatement of your financial statements. So again, if I'm talking to the 12/31 folks here, we're going to have to restate your 2023 financial statements, your beginning balances, to reflect this change. depending on which way we go, there are some decisions that need to be made by you all, and obviously we'll help you make these decisions, but it could be a pretty significant impact. This standard could by as much as 300 or 400% increase your liability that you have on your financial statements for compensated absences. So that's kind of the worst case scenario. There are other possibilities where the liability is going to be right about where it is now. So again, we'll talk about that, but we are going to have to restate your financial statements to reflect the implementation of GASB 101. Why did the GASB want to do this? You know, the joke that I started at our fall advanced governmental accounting session, some of you may have been there this year, is that we're going to start referring to them as the GASB instead of the GASB, the Governmental Liabilities Accounting Standards Board. They really like adding liabilities to the balance sheet. The real kicker with GASB 101 compared to some other standards, you know, if we're talking liabilities, you've got your pension, you've got your OPEB, you got your lease liabilities, you've got your SEBITA liabilities. The vast majority of them had a deferred inflow of, a deferred outflow of resources to kind of offset that liability from if we're just looking at net position. GASB 101 does not. So this could just be a straight up significant increase to the liabilities on your balance sheet, and the net position category that's going to hit 90% of the time is going to be unrestricted net position. So this could be a big hit on your unrestricted net position. Why did they do this? See on the slide there, they felt like they needed to add some more guidance to certain types of leave. Does this apply? Does this not apply? Just to get everybody on the same page, get some consistency. But if we can just for a second, because it also, another attempt, and I say attempt, was to bring kind of like a uniform or a unified model to calculating comp abs. Well, to explain what that means fully, we'll have to talk about what GASB 16 said about comp abs, or the options that we had under GASB 16. There were two approved methods under GASB 16. One was called the vesting method, and the other was called the termination method. So governments had options. And I don't know if I'll say that there were significant differences between the two, but there was definitely some inconsistency with those that did vesting versus termination. The vesting method was kind of a detailed analysis by employee in the likelihood that employee was going to receive some sort of a severance payment when they left employment, whether that be through retirement or termination or just leaving to go to another government or whatever. And so that was more of a detailed analysis. And then we had the termination method, where we looked at people that have left our entities, again, terminated, retired. We looked at what their balances of leave were at the time that they left, and then we looked at what we paid them out when they left to kind of come up with a termination percentage of payments, and then applied that percentage to the entire population of employees. So we had two different methods. GASB 101 is attempt to say, okay, we're not doing that anymore. You'll see that we've got one method, but there is something that I think was overlooked when the GASB put 101 together. We're going to talk about it a bit later, and it's called the flows assumption. That, and this is going to be a lot of our conversations as we move forward, is what is your entity's flows assumption? Depending on what that is, will have a very significant impact on what your liability looks like. So I think with 101, we are still going to have a lack of uniformity because of that flows assumption. And again, we'll talk more about that here in a second. Okay, so what is the scope of GASB 101? And I guess one more, as I dive into this slide, one more comment about where we're coming from. GASB 16, the focus of GASB 16 was on what am I going to have to, what is the potential amount I'd have to pay my current employees when they leave employment with me? So it was more of a severance package type thought process, end of employment thought process. And the biggest change with GASB 101, at least one of the three, I'll say, is this first bullet point item here. GASB 101 wants to capture, in addition to those payments that you may have to pay employees when they leave employment, it also wants you to capture and record now as a liability leave that your current employees have earned and that they are going to use in the future between now and that date that they leave employment. So that first item there, cash payments when the leave is used for time off. So just real quick on that, I mean, you could argue that if an employee, a 25-year-old employee has 100 hours of leave on the books at the end of any given year, there's a very good chance they're going to use that 100 hours as leave, making that whole 100 hours a liability for you at the end of the year. Now, I simplified that a lot, but you get the gist. We're going to have to come up with some way of estimating the amount of leave on the books, how much of it is going to be used by that employee. The second bucket there would be cash payments, very similar to GASB 16. Other cash payments, payments for unused leave upon termination or employment. That's basically the old method. We're picking that up as well. We're just adding this new bucket of what are they going to use while they're here. And that's why the leave could significantly jump up, because we're now picking up that bucket. The last bullet there that we're picking up, I haven't heard of anybody with this yet. I'm sure probably somebody on this call this is going to relate to, but any non-cash settlements where, and it gives the example, such as converting leave balances upon separation to a defined benefit post-employment plan. I feel like I'm pretty knowledgeable on OPERS and STIRS and SIRS and police and fire, and that this probably doesn't happen much, but I'm sure it happens. Those are going to be really unique circumstances, and if they apply to you, please make sure you bring that to our attention. We should be asking the questions, and we'll do our best to do that, but we're pretty much going into this under the assumption that that bullet number 3 is not going to apply to any of our clients. So please let us know if there's some sort of a plan in place, or if that's been happening, if that can happen at your entity. What does GASB 101 not include? We are not revisiting the termination benefit standard, GASB 47. Termination benefit, just because of the terminology, I'll clarify, is basically like if you had some sort of an incentive package to get people to early retire and you offered up $50,000 for anybody that retires to be paid out over a 5-year period of $10,000 a year or something like that. I mean, we see these types of things. They're not very common, but we do see them. We're not, GASB 101 is not talking about that. So we would still go into GASB 47 for guidance on those types of things. Okay. So now kind of the, this slide here is going to talk about how are we going to calculate this new liability amount? What is the recognition, and how are we going? What are we going to recognize, and how are we going to measure it? And this, the bold print there, is kind of my number 2 on the big ticket items. Number 1 being we now got to capture all of this leave that our employees are going to use and book it as a liability. And now this more likely than not. But let me get through this slide. In order for a leave to be accrued as a liability, it has to be attributable to services already rendered. Nothing's changed there. It is leave that they have earned the right to use. It has to accumulate. That is a clarification that was made here. So anytime you have like a vacation policy that is a use it or lose it, then we're not worried about booking the liability if it's required to be used within the reporting period. It's only for these leaves that accumulate from reporting period to reporting period that we want to try to capture. And then this bullet here, more likely than not to be used for time off. So again, we've added this time off piece. It's more likely than not to be used for time off or paid at settlement or through non-cash means. Those other bullets of what we're talking about here with the leave. So GASB 16 had a much lower bar for us. GASB 16, the terminology that was used was probable. They wanted you to book a compensated absences liability if it was probable that that employee was going to receive a payment from you when they left employment. And probable, they didn't define it, and they really didn't give any guidance on it in GASB 16. But I polled my audience up at GFOA Advanced this year, just by a show of hands, how did they interpret probable? And I started with 50%, 60%, 70%, 80%, and just had everybody raise their hands. And basically it fell somewhere in that 70 to 80% is where the majority of the hands raised up for what does it mean to be probable. So under 16, let's just say that the standard was if you're 75 or 80% sure that you're gonna have to make a payment, then let's book it. More likely than not is defined by the GASB in the standard is greater than 50%. Makes sense. So now we've depending on how you look at it, we've either raised that bar or we've lowered that bar. It's easier for things to be included now that we've dropped it from a 75 to 80% probability down to if you're more than 50% sure you're going to make a payment, we got to book it. So more things are being captured. And then just that last bullet there, talking about leave that has already been used. This is really focused on, your last, your accrued wage liability that you're calculating at the end of the year for that last payroll. It might be a payroll, it might be a payroll and a half of wages. There's going to be leave time that's being used in there that technically is a compensated absences liability. And the GASB, and again, that's new. We haven't typically picked up leave that's being used by our employees. They said, don't worry about that. They kind of threw us a bone there. They said, it's okay if you leave that in your accrued wages payable or accrued payroll, whatever you're calling that, on your financial statements. So we don't have to worry about that. Okay. So again, just a very high level. A lot of you looking at this list may be thinking, well, I've got 3 or 4 others that I'm thinking of. Please, that's the big part of this. Let's communicate. I can tell you that vacation and sick are the vast majority of the 2 types of leave that we've been booking up until now. And our thought is that's what we're going to be booking again this year. You've got this PTO, paid time off. I haven't seen that in practice, but it is becoming more and more common, probably more in the private sector than in the government arena. But vacation and sick, we know we're going to have to deal with them. The next slide, I'm going to talk a little bit about holiday, parental, and bereavement. But the GASB provided more guidance on these things. Sabbatical leave, again, not common, but there must have been some people accounting for that differently, that they gave some guidance on whether it's restricted sabbatical leave or unrestricted sabbatical leave, one of which, the restricted sabbatical leave, means that employee has work-related tasks that they need to complete while they're on sabbatical. And then an unrestricted sabbatical leave is nothing at all. You have no strings attached to it. The GASB said if those restrictions are significant, you would want to capture it as part of compensated absences. So again, a gray area that you need to make an estimate are the duties that are required during sabbatical leave significant? I need to capture it. Otherwise, sabbatical leave is not applicable. Talking about a couple of the others here, and I'll bring them up through the exclusions that are listed out in there. Leave, more likely than not, that is to be settled through defined benefit, post-employment benefits. Again, not very likely for that to be happening, but if it is, those are the types of things we're capturing with GASB 68 and GASB 75 with pension and OPEB. Compensated absences that are dependent upon occurrence of a sporadic event that only affects a relatively small proportion of employees. We're going to exclude those items. So again, parental leave, military leave, bereavement, jury duty. We're not going to try to capture a liability for those items, even though the vast majority of employees offer those leave benefits. They're not common enough for us to capture them. Unlimited leave, wouldn't that be nice? I haven't seen a government have an unlimited leave policy yet, but if it is, if it's, hey, you can take off as much as you, whenever you want, as much as you want, it's not something we're going to try to throw a number on and capture as a compensated absences liability. And then holiday leave. This may be something that comes into play. I know our firm offers floating leave, but floating holiday leave. But if you have holiday leave that is on a schedule, meaning the employee, it's not at the discretion of the employee, Christmas Day, New Year's Day, July 4th, you know, all of the holidays that you give, those are not to be included as part of compensated absences. But if it's not on a schedule, again, Ray, we offer our employees 3 days of floating holiday leave. Those days don't accumulate from year to year, so it's still not applicable. But if you have a floating holiday leave offering at your entity and that leave rolls over or accumulates from year to year if it's not used by the employee, it is something that we're going to want to factor in here with GASB 101. So again, back to this list, please, please, please. I mean, we can, when we have our next conversation with you and you think there's 2 or 3 other items on here, have that conversation with us. Let us dive into it. And let's collectively together make a determination of whether or not it's something we need to be looking at this year, whether we have in the past or not. Okay. So more likely than not, this is really just about what, you know, how we're almost starting from scratch here. I mean, we've been booking comp abs and we've been asking you for your policies and your union agreements every year. We should be making sure we've got a current copy of that in our files. And anytime you go through a change, we should be looking to make sure it hasn't had an impact. But we really have to focus on that this year. There's a good chance our work papers, the files that we have are a year or 2 old, or if not more. We're going to want to be confirming with you that we have the latest and greatest so that when we review all of those policies and procedures and union agreements, we all get on the same page of what those criteria are in there that determine how much employees get paid out. This could get tricky with different classifications of employees. One of the reasons I mentioned earlier, I think our schools was a bit easier. They've got a little, you know, they're kind of more falling under one umbrella compared to the cities and counties, and 1231s are a little more decentralized. But what we did with our 2 schools that we early implemented is we did an evaluation of the individual classes of employees, those employees that fell under different union agreements and just different policies, classified, certified, and administrative. We did a calculation of each of those employee classes individually. And then we did calculations of the liability of all employees treated as one under one set of policies. And the variance was very insignificant. So our plan moving forward, and it's probably going to be the same for every school district that we work with, is that we don't need to dive in to do separate calculations for different classifications of employees. But when I think about cities and counties and police departments and fire departments and you know, boards of developmental disabilities and job and family services, you've got all of these different, you know, the cities and counties are made up of 10, 12 different companies that all just happen to roll together into one reporting model. But I think we're going to see that the policies and agreements are going to be very different. This first year, our approach is going to be to really try to tackle that and look at each one of your classifications of employees to make sure we get it right. Hopefully in the end, we come to the assessment that it's not material for us to do that because it's going to mean more work, and that we're going to be able to come to a method that is more high level, entity-wide type approach. So, but we are going to have to do a deep dive into those. I mentioned formal policies and union agreements. You may also have some informal policies that are happening throughout your entity. We're going to want to talk about those too, because if your formal policies are saying one thing, but in practice you're doing another, you know, an auditor might pick up on that. So we know, just like we're spending the time now with you to dive into this, your auditors are really going to hit it hard this year. This is going to be the hot topic that they're going to want to make sure we get it right. That third bullet there, historical information. So we've got these two buckets that we're creating. Okay, we've got how much leave is going to be used by your employees. That's bucket number one. The method that we used and that we're hoping to use with all of our clients is looking at the relationship of how much leave is earned by your employees versus how much is used by your employees. And basically, our two early implementations came out to, I'm just going to say 75%. So by that, I mean, if your employees earn 10 hours of leave per year, they're using 7.5. It's a burn rate of 75%. And we're trying to get history on that. So that's the challenging part for you all from a reporting standpoint. We eventually want to get to where we have 10 years worth of historical information on that so that we can feel good about that number. In this year of implementation, we're hoping to start basically from 2021 on. We want to try to avoid the COVID leave issues that happened in 20 and really maybe even 21. But we do want to get a couple, 2-3 years worth of information on that to come up with how much leave are your employees using, so that we can develop an expectation of what's going to be used moving forward. So that's a new piece. You should have all received, at least the 1231 clients that are on the call, you should have already received from us a request for documents that are going to give us that information. We're not doing, we don't need it by employee. We're going to try to just do a global calculation of this, but we need to come up with an average. How much is being earned by employees? How much is being used by employees? But we're seeing this leave bank increasing every year. Basically, people aren't using, but on average, people aren't using as much leave as they earn. So that's the one bucket, what's going to be used. The other history, for those of you that were doing the termination method under GASB 16, shouldn't be anything new to you, but we're trying to get history on, okay, when people leave employment with us, how many hours of leave do they have on hand? And how many hours of leave do we pay them? And that develops a percentage as well. It's usually going to be a lot lower because obviously vacation is going to be paid out at 100%, but sick leave is a much smaller percentage when they leave employment. There's usually some thresholds in there that they're going to be paid out, up to a maximum 50%, up to a maximum of 300 hours or something like that. There are some parameters on how much that amount can be. So it's typically a smaller number. We're going to continue to get historical information from you on that by asking you, okay, how many people left employment this year? For every one of those employees, or maybe if you're a larger entity and that's in the hundreds of people leaving every year, maybe we select a sample and we just look at 50 of those employees, but we need to develop some analytics to calculate a percentage of what are we paying people out when they leave, so that we can then again apply that to the population. And then of course, any known information, we're making this effort to gather all of this historical information. Has something changed? Has a union agreement changed? Has a policy changed that says we can't use that anymore? This is the new method. Let's take a look at that. So again, this is going to be the big pull on you, this slide, and getting this history from you, because for both buckets, it may be new to you, that type of information. So we're going to be asking for 2 to 3 years, and you may say, Ray, I'm sorry, I just can't do it. I don't have the staff to compile that information. And we just have to put together a plan of attack, or maybe we're only using 1 year's worth of information or some other method. If we're willing to talk with you about your thoughts on what is the best way to estimate these things, but we're going to have to come up with some estimates. Okay, I've only got a couple more slides left. I think there'll be plenty of time in the end for questions. So let me just dive into kind of, I guess, hot topic or biggest change item number 3. I alluded to it earlier, and that's the flows assumption. And this is where, I've been on a number of calls. I did a technical inquiry with the GASB, and I've watched some video calls where the GASB has met with other entity types about this topic, and it definitely is something that I think was overlooked. when they put together 101 as far as the massive swing and what our liability looks like, depending on what your flows assumption is. So again, the flows assumption, and again, we've got these two main buckets that we're focusing on. How much leave on hand at the end of the year is going to be used by my employees, and whatever we don't determine is going to be used by them, we have to say, okay, well, how much of this will I pay out to my employees when they leave, based on more likely than not. So this flows assumption, FIFO versus LIFO. I'm sure a lot of you on the call have heard of both of those as it relates to how the options that we have to accounting for inventory. FIFO is the first in, first out assumption, flow assumption. LIFO is the last in, first out. And so the only thing that the GASB mentions in the standard is they were originally going to require FIFO, but that they were informed through the whole exposure draft process that certain clients use the LIFO method, and I'll dive into each. So they just have a couple paragraphs in the back saying, we were thinking about requiring FIFO, but then we heard about this, so we're not going to require anybody to use whatever. It's going to be whatever, it's your choice. Whatever your entity is using is what you will use, FIFO or LIFO. And again, the impact of that decision is very significant. So under the FIFO method, first in, first out, the assumption is that when an employee uses an hour of leave, they are using that first hour of leave that they earned that's still on the books that might have been 5-10 years ago. They're using that first hour first, and then everything that they're earning in the current period is basically just getting banked and will be used at some future time. The LIFO method makes the assumption last in, first out. So when an employee uses leave, they're using the leave that they just earned that pay period. So FIFO versus LIFO. And the reason that, and so maybe some of you now are thinking about this and you're saying, I have no clue, because that's the vast majority of what we hear from people. But some of you may also be saying, oh, we're definitely FIFO because of A, B, or C, and the same with LIFO. We are going to have more conversations with you about this because this is not something we can decide for you. We want to make sure we're giving it a lot of thought and that we don't say we're going to be FIFO and an auditor is going to come in and say, well, you're doing this over here and this sure looks like LIFO, or vice versa. Why is it such a big deal? And really the main thing comes down to this: to be used for time off. If you make an assumption that somebody has 500 hours worth of leave on the books, and we already know that employees on average are using less hours of leave than they're earning every year, meaning that bucket is going to continue to grow, that 500 hours. Then if you're using the LIFO method, you could argue that at the end of the year, none of those 500 hours will be used by that employee under the LIFO method, because they're just going to use that what they're earning in that year, and they're going to, whatever they don't use of what they earn that year is going to be added to the bucket. So that pushes the whole 500 hours. When we go to say how much of that 500 hours is going to be used for time off, the answer is going to be 0. And it's all going to be pushed to bucket number 2, where we say, okay, well, how much of this 500 hours will we pay out to this employee when they leave? And so we're not going to get out of that, but that percentage, that termination percentage, if you will, is going to be much lower than 100%. It's going to be about 20% if you look at all employees. Whereas under FIFO, if I say first in, first out, then I have to say, I have to come up with a fairly high percentage. It's probably going to be closer to 75% of how much of that 500 hours is going to be used by my employees. Well, I know they're using it. So a very large percentage of that, calculated at 100%, is going to be used by my employees. So just big picture. And again, we have to spend time and talk about this. It can't just be about what is the size of the liability on my financial statements. But But it is a pretty significant difference. Our two early implementers, we used the FIFO method for both of them, and the liability basically quadrupled. So if the liability was $2 million under SAS 16, it was $8 million under GASB 101. And we didn't, neither of our early implementers used LIFO, but basically, I think LIFO would still end up being higher than GASB 16, but it probably won't even be double what GASB 16 was. It's probably just going to be a certain percentage higher, just because we're capturing more leave balances into this bucket of how much are we going to pay out our employees when they terminate. But it is going to be closer to what it is under GASB 16. So again, if you're three big things that we're pulling out of GASB 101, we have to take a look at what is going to be used by our employees. We've never done that before. Two, we've got a new bar. It's more likely than not. We're not using probable anymore, more likely than not, which is greater than 50%. And three is our flows assumption, FIFO versus LIFO. You have to, we'll have conversations about this. We got to pick one, and you're ultimately going to have to support that conclusion when your auditors come in. Because again, I'll just reiterate that the GASB was going to require FIFO, but they didn't. And so we just, any auditor can see that in the exhibits in the back of the standard that, hey, this is kind of was you could argue was the intent, but again, since the issuance of 101, they've come out and said, you're right, you pick whichever one you want, just make sure it agrees to what you're doing in practice. So get ready for some more conversations on the flows assumption. Nothing new here. We're going to use, when we go to calculate these liabilities, we're going to use the employee's rate of pay as of the date of the balance sheet. Regardless of what method we're using, FIFO, LIFO, it doesn't matter. When we go to calculate the number of leave hours for each one of these buckets, and here are the hours on hand, what are the pay rates? We're probably going to be using like an average pay rate in some cases, because again, our goal is not to analyze each employee, because we're talking about hundreds of employees on the low end. We're not going to evaluate each employee. We're going to put people into buckets, or maybe even just look at employees in total, look at average pay rates, average leave usage, and apply current pay rates to these leave balances. Salary related payments as well. This isn't a significant thing. We're probably not going to do this based on immateriality as far as Social Security and Medicare taxes. Social Security is very uncommon to see. It's basically just for board members and a really small population of employees. Medicare taxes is everybody, but it's only 1.45%. And in the grand scheme of things, it just adds a layer to this calculation that can be avoided. And other firms in the auditor state, that seems to be the common theme there, is that that's immaterial. It also excludes any payments to defined benefit pension plans and defined OPEB plans. Again, defined benefit, defined OPEB, it's already captured in 68 and 75 for all the pensions. We're already capturing that liability there. But we are including, which this may be, I don't think it's material now, but it may eventually be something that we have to consider, and that is payments that employers are making to defined contribution plans. I think OPERS does the best job of this as far as the reports that they give out at the end of the year about what percentage of a particular entity's contributions to their system was for defined benefit and defined contribution. So the numbers are kind of there, but they're a little more difficult. But maybe 10 years from now, maybe defined benefit pensions and defined benefit OPEBs don't exist anymore. Maybe the whole process is all about defined contribution, to where the vast majority of your employees are contributing to those plans, and so your employers are contributing to those plans as well. It may become significant. So it's worth a conversation, but I don't think your employees and your entities are making significant contributions to defined contribution pensions and OPEB. One thing that was nice that they did with the note disclosure requirements, if you guys had anything to do with preparing your note for CompABs under the old one, you always had to show the net increase, or not the net, but the increase and decrease in what your comp abs liability was every year. So what we would do is we would calculate one or the other. Typically, the amount that it increased was easy because we would just say, okay, employees are earning this much. This is the average rate of pay. This is how much it increased this year. And then decrease was just a plug. And it wasn't anything that we could ever support from an audit standpoint. It was just what we needed to get to what our ending liability was. They said, we don't have to do that anymore. We don't have to present increases and decreases. We just have to present a net increase or decrease in the liability. So again, it's a plug. The note, we still have to show beginning balance and ending balance. And we just have to have one number in there. We have to label it as such. We have to call it a net increase or decrease. So you're probably going to have to disclose that at the bottom of the table, that comp abs change is a net increase or decrease. But it saved us the time from doing just an additional calculation. So that's all I have. I don't know, Becky, if we got any questions that came in, or if anybody wanted to throw something out there now, we could try to address a few questions, and I'm also happy of giving you all back 20 minutes of your lunch hour.
We do have just a couple questions that came in, but yes, in the room right now, I'm still going to be looking through them. So if you guys have last minute questions, please add them. For the first one, what about the paid medical leave? Would that fall under the second exclusion? Can't talk.
Paid medical leave, and let me just go to the exclusion that you're talking about. Actually, I don't know if I can do that or not, but paid, I mean, so again, is it attributed to services already rendered? I would assume that it would be. Does it accumulate? Are there hours that are being earned by employees, or is it just something they get when it happens? So it would have to accumulate for the answer to be yes. And meaning they would get so many hours, and that every year that would keep getting bigger and bigger and accumulate. But then I think even more importantly than that, I think we need to focus on, where was it at? This here. This, if it's dependent upon an occurrence or a sporadic event that affects a relatively small proportion of employees. I guess every entity could be different there. I suspect it would fall under this exclusion. And I think that's probably the exclusion you were referring to, but it's just something that you want to bring to our attention. Let's look at it. Let's talk about each one of those components and make a decision on it, and just make sure we get it documented so we're ready for the auditors.
Okay, thank you. We did have someone ask, yes, the slides will be emailed afterwards. Okay, next question. How does accrued comp time work?
My understanding of it, I accrued comp time back in my days working for the Auditor of State's office. So again, not a ton of experience with this, is that you work overtime, and instead of, you earn for however many hours you work over, you either get a 1-for-1 and you start to accumulate this comp time, which I've always known, at least for the state of Ohio, this is the case. Like that comp time is basically treated like vacation. You can use it whenever you want to, and if you were to leave employment, that would be paid out at 100%. So that's my understanding of it, is basically it would be treated in the exact same way as vacation would be. That may not be the case at all governmental entities, so we'd have to take a look at it to see, but that's my understanding of comp time.
Okay, perfect, thank you. Okay, next question. Do you have any recommendations on explaining this to our board? I can see many boards being confused when they see this large liability for the first time on our financial statements once it's implemented.
Yeah. Unfortunately, I mean, it's like Groundhog's Day, right? I mean, it's the same conversation you must have had with them when GASB 68 and GASB 75 came along. I mean, I mean, we do have to follow the guidance that the GASB is putting out there. I mean, if we don't follow the guidance, the alternative would be to get some sort of a qualification on our opinion, or if we weren't willing to adjust those financials. One thing that governments did with 68 and 75 to make it a little more palatable and to basically explain to not only our boards but the readers of our financials that, hey, if we don't believe this to be the impact on net position to be a true reflection of where we are. So if I were to back these items off, this is kind of what my unrestricted net position, or whatever you think your key number is that you think is skewed. So the MD&A will give you very little, but some room to kind of explain that better. But hey, ask if it's just a matter of the technical side of it. I know I'll speak for us Ray folks. We'd be happy to sit in on those board meetings to help explain that. But you're right. It is just it is a tough thing to get your head around, as far as why am I booking a liability for leave that will be used by somebody in the future. Don't already have that really captured in that person's salary or that person's wage. So it is a tough concept.
Okay, perfect. Thank you, Jared. And then we just had a couple people ask if you could share the examples of those who early implemented, the school districts that did it.
Yeah, absolutely. I'll just want to scrub them up a little bit. But actually, when I did my advanced GFOA training back in August, I had an example there to share with folks to let them see what that looked like. And I can tell you, since then, that was before we had finished that early implementation, and really before the cash flows assumption, the flows assumption thing kind of became more prominent. But so it looks a little bit different now. But we have, you're all Ray clients. We're happy to share with you the resources that we've put together to kind of calculate this. Yeah, what's ours is yours.
Perfect. All right. Well, I
would start with. Well, no, I'll leave you can go directly to me with that. I'll kind of save our preparers some emails. I'm happy to share that. And if it's a month later and you're talking with your preparer, they're all going to have a copy of that sooner or later. So.
Oh, we just had another question pop in. How is leave that is transferred in from another entity treated? Is it leave earned on the first year of employment?
Yeah, there isn't. The GASB didn't touch on that. That happens kind of confuses me a little bit, particularly when I dive into the trees of GASB 101 and I see the dollar amount that's associated with that. But yeah, that's all going to fall into kind of the same conversation we're having about flows assumption. I think it is something, if it's something that more likely than not is going to result in a payment that you make to that employee, it's going to have to be factored into your compensated absences liability.
Okay, I'm doing one more quick. Okay, that was everything. So yeah, thank you, Jared. Any last thoughts as we wrap up?
No, just hey, we're here for you. This webinar in no way is kind of pushing off our responsibility to you. It's just informing you to let you know, hey, this is going to be this is going to be a challenge. Let's jump on it as soon as we can. Let's knock this thing out, and come March, let's all have this all wrapped up. And we know it's going to mean a lot to you guys, but a lot of work. So communicate with us. And ultimately, we're here to help you out and get this wrapped up. So.
Perfect. Thank you so much. And as a reminder, everyone, email will be sent to you either later today or tomorrow morning with the recording and presentation. And then don't forget to jot down Jared's email if you have any additional questions. We appreciate your time and hope you guys have a great rest of your day.
Thank you.